Your relationship with money isn't bad. It's just leaking from places you've never looked. That subscription you forgot about 3 months ago is still charging. The convenience purchases that seem insignificant are adding up to hundreds of dollars every month. Lifestyle upgrades happen so gradually you didn't even notice consumed before a raise ever hits your account. You earned decent money more than 5 years ago, and yet the savings account sits in roughly the same place. The gap between what you make and what you keep seems to widen no matter what you do. After years of obsessively watching where money actually goes, here's what I've learned. My friends, most people don't have an income problem. They have a leakage problem. Money flows out through dozens of tiny holes that have never been identified, never measured, never plugged. This video covers 20 frugal habits that saved me thousands of dollars. Not through painful deprivation, but through seeing clearly where money was disappearing and making small changes that compounded dramatically over time. Some of these habits I still follow religiously. A few I took too far and now regret. I'll tell you which ones crossed the line so you can find the balance that works for your life. By the end of this video, you'll look at your own spending differently. You'll spot leaks you didn't know existed. And you'll have specific, actionable changes you can make starting today. The first habit changed everything else. I stopped eating out except for genuinely special occasions. For about 3 years, my girlfriend and I ate at restaurants maybe 2 or 3 times per year. Not per month, per year. That sounds extreme because it is. But when you're serious about building financial freedom, the math becomes undeniable. The average American household spends over $3,600 annually on food away from home. A casual $50 per week on restaurants, which doesn't even feel like going out that much, adds up to $2,600 per year. We redirected all of that money toward savings and investments. Over 3 years, that single habit contributed over $10,000 to our net worth, before accounting for the returns those investments generated. I'll be honest about the trade-off. We missed some social experiences. There were dinner invitations we turned down. It required being comfortable with being different from our friends. But here's what I learned. You can still have a social life without restaurants. Hosting dinner at home, meeting for coffee instead of meals, suggesting free activities. The relationships that mattered survived. The ones that required expensive outings to maintain probably weren't that deep to begin with. Related to eating out, we transformed how we handled food at home through aggressive meal planning and bulk cooking. Every Sunday, we'd plan the entire week's meals, buy only what we needed, and cook large batches that would last multiple days. Rice, beans, chicken, potatoes, vegetables, simple ingredients prepared in bulk. This habit attacked multiple money leaks simultaneously. Food waste dropped to nearly zero. The average American household throws away over $1,000 of food annually. When you plan precisely and cook what you buy, that waste disappears. Impulse grocery purchases stopped. When you shop with a specific list for specific meals, you're not adding random items. Takeout temptation vanished. When there's already food prepared at home, ordering delivery means paying 3 times as much for something less convenient than opening your refrigerator. I'll admit, we took this one too far. For several years, we ate chicken breast with rice or beans almost every single day. It was the cheapest protein we could find. The savings were significant, probably a few $1,000s over those years, but I genuinely don't enjoy chicken anymore. I overexpose myself to the point where it's no longer appealing. That's a real cost that doesn't show up in any budget spreadsheet. Find the sustainable version of meal planning that works for your life. One habit that required zero ongoing effort was automating savings before I could spend them. Most people save whatever is left at the end of the month. This is backwards, and it's why most people never save enough. There's always something that consumes the leftover. An unexpected expense, a social obligation, a purchase that felt justified in the moment. The fix is simple. Move money to savings and investments automatically the same day your paycheck arrives. Before you see it, before you can spend it, before your brain even registers it as available. I set up automatic transfers that triggered on payday. The money disappeared before I could make decisions about it. My spending naturally adjusted to what remained. This works because it removes willpower from the equation. You're not fighting yourself every month about whether to save. The system handles it. Your job is just to live on what's left. In 2026, high-yield savings accounts are paying 4 to 5% APY. Your automated savings, can earn real returns while sitting in an accessible emergency fund. Another habit that costs nothing but saves hundreds annually. I learned to treat bills like suggestions rather than fixed prices. Your internet bill, your phone plan, your insurance premiums, your subscription services. These companies raise prices constantly because they assume you won't notice or won't bother to push back. Spending 1 hour comparing rates, threatening to cancel, or actually switching providers can save you hundreds of dollars per year. 1 hour of effort for several $100s in savings. You will never find another use of time that pays this well. I call my internet provider annually and tell them I'm considering switching to a competitor. Almost every time they offer a discount or promotional rate to keep me. The same approach works for insurance. Getting quotes from competitors often triggers price matching. In 2026, comparison tools make this even easier. The information asymmetry that companies used to exploit has largely disappeared. Use it. One of the biggest savings came from a decision most people consider non-negotiable. We lived with one car for years. Even with a paid-off vehicle, car ownership costs thousands annually. Insurance, registration, maintenance, repairs, depreciation, fuel. A second car that sits waiting most of the time is bleeding money constantly. We ran the numbers and realized our second car was being driven maybe twice a week. The annual cost of ownership divided by actual use made each trip absurdly expensive. We sold the second car and made it work with one. Was it inconvenient sometimes? Yes. It required coordination and occasional creativity. But the savings were substantial. Easily, $3,000 to $4,000 annually that went straight to investments instead of sitting in the driveway depreciating. This isn't possible for every household. If both partners commute to different locations daily, you need 2 vehicles. But if you work from home, or if your schedules allow sharing, run the numbers. The cost of occasional inconvenience might be far lower than the cost of a vehicle you barely use. When we did have cars, we always paid cash for reliable used vehicles. I started with a $5,000 Honda Civic that I saved for years to buy outright. Nothing fancy, nothing impressive. Just reliable transportation that didn't come with monthly payments. The average new car payment in 2026 exceeds $770 monthly. That's over $9,000 annually before insurance, fuel, and maintenance going toward a depreciating asset. We took that $9,000 and invested it instead. Over 10 years at average market returns, that's roughly $150,000 in wealth that most people trade for slightly nicer transportation. Buy reliable used cars in cash, drive them until they're truly done. The freedom from car payments is worth more than the status of a newer model. Housing was where we made the most aggressive move, house hacking. We bought a 3-unit multifamily property with a first-time homebuyer FHA loan at 3.5% down. We lived in 1 unit and rented out the other 2. The rental income covered our entire mortgage payment, meaning our housing cost effectively dropped to zero. Most people spend 30% or more of their income on housing. We spent 0%. That difference went directly to savings and investments, accelerating our timeline dramatically. We took it even further. One of our units had 4 separate bedrooms, so we added a bathroom and rented each bedroom individually on Airbnb. That generated about $2,000 monthly in profit after mortgage, taxes, and insurance while we lived in the same building. This single strategy is probably what allowed me to leave my day job years earlier than would have otherwise been possible. When your largest expense disappears, everything else becomes easier. House hacking isn't for everyone. It requires being a landlord, dealing with tenants, maintaining property. But if you're willing to do the work, it's one of the most powerful wealth-building strategies available to people without large starting capital. I also learned to DIY almost everything related to home maintenance and improvement. When we bought that first property, I had never done anything beyond painting a room. I taught myself to tile showers, install flooring, do basic plumbing and electrical work, refinish cabinets, and handle dozens of other repairs. Between the apartments we renovated, DIY saved us tens of thousands of dollars. A contractor would have charged $300 to install a toilet. I learned to do it in an hour by watching YouTube tutorials. A professional tile job would have cost thousands. I did it myself over a weekend for the cost of materials. These skills compound over time. Every repair you learn to do yourself is a repair you'll never pay for again. Over a lifetime of homeownership, the savings are enormous. The barrier to DIY is mostly psychological. People assume they can't do it because they've never done it. But most home repairs are far simpler than they appear. Start with easy projects. Replacing a faucet, fixing a running toilet, patching drywall. Build confidence. Gradually take on more complex work. For furnishing and home improvement materials, we relied heavily on thrift stores and dented and dinged sections. When we needed paint, we bought it from thrift stores, often for a few dollars per gallon instead of $30 or $40. When we needed appliances, we bought from clearance sections at home improvement stores, where items with cosmetic damage sell for 50% off or more. I actually turned this into a side hustle for a while. Every time I went to Lowe's, I'd check the dented and dinged section. If there was an appliance priced significantly below retail, I'd buy it, load it in my car, and resell it for profit. The margin on a scratched refrigerator that functions perfectly can be several $100s. Your appliances are going to get scratched and dented eventually anyway. Paying full price for pristine items that will acquire cosmetic damage within months of normal use makes no financial sense. On technology, I avoided the upgrade cycle entirely by buying refurbished devices. For years, I used refurbished Google Pixel phones that cost around $100 on Amazon. They did 98% of what flagship phones did. The camera was slightly worse. The processor was slightly slower. The text bubbles were green instead of blue. None of that mattered for my actual daily use. I saved roughly $800 to $1,000 per phone cycle compared to people buying new iPhones every 2 years. I only switched to a newer phone when I became a content creator and genuinely needed better camera quality. That was a tool for generating income, not a status purchase. Most people upgrade phones, laptops, and other electronics far more frequently than necessary. Before any tech purchase, ask yourself, does my current device actually fail to do something I need, or do I just want something newer? We implemented a strict no-gifts policy with family and friends. Every birthday, every holiday. People feel obligated to buy each other random items that the recipient will donate or throw away within 6 months. It's a wealth transfer to retailers disguised as affection. We told our family directly, we're not buying you gifts, and please don't buy us gifts. If we want to celebrate together, let's share a meal or an experience. But we're done with the ritual exchange of stuff nobody actually wants. This was socially awkward at first. People were surprised. Some were mildly offended, but over time, everyone adapted. The holidays became less stressful, less cluttered, and significantly less expensive. We still do gifts for kids. They're young enough that the experience genuinely matters. But between adults, the obligation gift-giving has stopped. That saves hundreds of dollars annually while actually improving the quality of our celebrations. A small habit with surprisingly large impact. I stopped paying for drinks almost entirely. Bottled water, coffee, soda, juice, these are some of the highest margin products retailers sell. The markup on a $2 bottle of water is astronomical. The $4 coffee represents a few cents of beans and milk. I carry a water bottle everywhere. I make coffee at home. At restaurants, I order water. The savings seem trivial on any individual purchase, but they compound to hundreds or thousands annually. A daily $5 coffee habit costs over $1,800 per year. That same money invested for 30 years at average market returns becomes roughly $40,000. The coffee isn't bad. The opportunity cost is. I track every dollar that comes in and goes out. Not obsessively, but consistently. Most people think they know where their money goes. Almost nobody actually does. When you start tracking spending, even for just 1 month, you uncover subscriptions you forgot about, fees you didn't notice, categories that are double what you estimated. I use a simple spreadsheet, though apps work fine too. The specific tool matters less than the habit. Knowing where your money goes is the foundation of controlling where your money goes. Tracking reveals patterns you can't see otherwise. You notice that grocery spending spikes on days you shop hungry. You realize that certain social situations reliably trigger impulse purchases. You discover that entire categories you considered essential are actually optional. Once you see that you're spending $400 monthly on food delivery, you can't unsee it. The number creates its own pressure toward change. Related to tracking, I became obsessive about eliminating fees. Bank fees, late fees, ATM fees, Subscription renewal fees, convenience fees, these charges are designed to be small enough that you don't complain, but they add up to a significant drain over time. Americans pay an average of over $300 annually just in bank fees for the privilege of a bank holding their money. That's pure waste. I switched to no-fee bank accounts. I set up autopay on everything to avoid late fees. I never use out-of-network ATMs. I review subscriptions monthly and cancel anything I'm not actively using. These changes required maybe an hour of setup and a few minutes of ongoing attention monthly. The savings compound forever. Before any non-essential purchase, I apply a waiting period. What some people call the 30-day rule. When I want something that isn't a genuine necessity, I write it down and wait. 7 days for small purchases, 30 days for moderate ones, 90 days for anything significant. What happens during the waiting period is fascinating. Most desires simply fade. The thing that felt urgent and necessary gradually loses its grip. By the time the waiting period ends, you often can't remember why you wanted it so badly. His rule saves money not by forbidding purchases, but by exposing which desires were genuine and which were momentary impulses. The purchases that survive the waiting period are usually ones you genuinely value. We also experimented with no-spend challenges, periods where we bought absolutely nothing beyond true essentials. A no-spend day is easy. Just don't buy anything except what's genuinely necessary. A no-spend week is harder, but manageable. A no-spend month is a complete reset that reveals how much habitual spending you don't notice. During these challenges, you discover how often you spend out of boredom rather than need. You realize how many purchases are attempts to solve emotional problems that money can't fix. After a no-spend month, your habits are different. The automatic impulse to buy has been interrupted. You return to normal life with clearer vision and more intentional spending. One principle I apply to everything. I calculate costs per use before buying. A $50 shirt worn 50 times costs $1 per use. A $100 jacket worn 200 times costs 50 cents per use, but a $20 sale item worn twice costs $10 per use, making it more expensive than the higher-priced alternatives. This reframes value completely. The question isn't, is this cheap? The question is, how much will each use cost me? This calculation often justifies spending more on things you'll use heavily. Quality items with long lifespans and frequent use are actually cheaper than budget items you'll replace repeatedly. It also reveals purchases that never make sense regardless of price. A ski jacket for someone who skis once every 3 years will have terrible cost per use no matter how discounted it is. For items I needed temporarily, I joined Buy Nothing and local sharing groups. Need a ladder for a one-day project. Borrow it. Need a drill for a single repair? Someone nearby has one they're not using? Need a car seat for visiting family? It's available without buying. These groups create microeconomies where spending becomes optional. You share what you don't use, others share with you. The transaction costs disappear. The need to own every possible tool vanishes. This is particularly powerful for things you'll use rarely. Camping equipment, specialty tools, occasion-specific items. Owning means paying full price to use them a few times per year. Borrowing means paying nothing. Perhaps the most important habit was avoiding lifestyle inflation despite increasing income. When most people earn more money, they spend more money. A raise leads to a nicer apartment, a bonus leads to a better car, a promotion leads to upgraded everything. Within months, the higher income has been fully absorbed by higher spending, leaving savings unchanged. We intentionally kept our expenses flat regardless of income growth. When my side hustle started generating additional money, we didn't expand our lifestyle. When YouTube began producing real revenue, we maintained the same baseline expenses we'd had when I was cleaning office buildings. All the additional income went directly to savings and investments. The gap between income and spending widened, accelerating wealth building dramatically. This required constantly resisting the pull toward upgrades. Friends questioned why we still drove the same cars, lived in the same place, maintained the same lifestyle, despite obviously earning more. But lifestyle inflation is why high earners often have the same financial stress as low earners. Their spending rises to match whatever they make. The only escape is intentionally keeping expenses disconnected from income. The final habit was side hustle stacking, always having multiple income streams beyond my main job. While cleaning office buildings at night, I simultaneously started a YouTube channel, worked construction during days, and got my real estate license. Most of those side hustles failed. YouTube eventually took off, but the approach was never about any single attempt succeeding. It was about increasing the surface area for luck. The more things you try, the more likely something connects. I gave up video games, TV shows, and most leisure activities for several years to make time for building income streams. Every night and weekend went toward creating something that could eventually replace my job. This sounds extreme because it was. Not everyone wants to sacrifice that much. But if you genuinely hate your main job and want to escape it, the nights and weekends are when you build the exit. Now, let me be honest about what I got wrong. Some of these habits went too far. The chicken everyday diet saved money, but cost me genuine enjoyment of food I used to like. The modest wedding saved thousands, but left us without photos and memories we now wish we had. The intense focus on frugality during our early years meant missing some experiences that would have been worth the money. Frugality is a tool, not a virtue. The goal was never to spend as little as possible. It was to build freedom and security. When frugality starts costing you things that genuinely matter, it's working against its own purpose. Find the sustainable version of these habits, the ones that save money without making you miserable, the ones you can maintain for years without burning out, and recognize that frugality has diminishing returns. The first 20% of effort, automating savings, eliminating obvious waste, avoiding lifestyle inflation produces 80% of the results. The extreme measures produce marginal additional savings while consuming disproportionate willpower and joy. Here's what ties all of this together. Every habit I've described is a form of financial literacy in action. Not the textbook kind about compound interest formulas and assets. Allocation, the practical kind about seeing where money actually goes and making conscious choices about it. Most people never examine their spending at this level. They react to money situations, pay the bill, cover the expense, fund the lifestyle without understanding the patterns underneath. That lack of awareness costs them thousands annually, year after year, for decades. The people who build real wealth aren't necessarily the ones who earn the most. They're the ones who see clearly where money leaks out and systematically plug those leaks. They're the ones who make spending intentional rather than automatic. I made a complete breakdown of financial literacy that goes deeper on all of this, not just frugal habits, but the entire system of how money works, how wealth compounds, how to build structures that grow your net worth automatically. If any of these habits resonated, if you recognized leaks in your own finances or saw opportunities you haven't captured, that video will give you the complete framework for making your money work for you instead of disappearing into expenses you barely notice. Most people will watch this video, nod along, and change nothing. They'll keep spending automatically, keep wondering where their money goes, keep feeling like they're not getting ahead despite earning reasonable income. Don't be most people, my friends. Pick 3 habits from this video. Implement them this week. Track the savings for 1 month and watch how quickly small changes compound. The leaks in your finances are real. They're costing you thousands, but they're also fixable, often with minimal effort and no sacrifice of things that actually matter to you. The money is there. You just have to stop it from escaping.